G'day everyone and welcome to another episode of the Aussie Dividend Machine. Franking credits are an important part of dividend investing in Australia, so it's really important that you understand exactly what they are and how they might benefit you. I'm going to break this video down into the following sections. Firstly, what are dividends and franking credits? Next, we'll look at a basic example of franking credits and how they might work depending on your occupation and income. Then we'll take a more detailed look at a real example of a company that pays a fully franked dividend. And at the end of the video, I'll show you how to find out what companies pay franked dividends, what companies don't, and how to predict whether or not a company will pay a franked dividend going forward. And while you're here, make sure to give the video a like. It really helps support the growth of the channel. This video is for your entertainment only and does not constitute any kind of financial advice. Before you make any investment decisions or taxation decisions, make sure to go and see a professional financial advisor or accountant. So with that out of the way, let's get right into the details. So first up, what are dividends? When a company earns a profit, they can do a number of things with this money. 1, they can reinvest in the company. 2, they can buy back shares, and 3, they can distribute those profits to shareholders, and these are called dividends. Okay, so that's the basics of dividends covered. What about franking credits? If a company pays tax on their profit before they distribute the dividend is known as a fully franked dividend. Fully franked meaning that the company has already paid the tax. If a company doesn't pay the tax before they distribute a dividend, this dividend is known as an unfranked dividend. So how are the two different? Because of the imputation taxation system, a shareholder who receives a fully franked dividend doesn't need to pay the tax that the company has already paid again. In essence, this means they get a tax credit. The value of this tax credit is equal to the amount of tax the company has paid before distributing the dividend. Now, the taxation rate for companies differs from country to country. In Australia, it's 30%. This means that 30% of the value of the dividend is held by the tax office. So what happens to this money that the tax office holds? Well, that depends on your personal income situation. So you want to know exactly what that means for you? Well, let's move straight on to the examples. Okay, so in our first example, let's look at a fully franked dividend of $100. For these examples, we'll use 3 different income types. Number 1, earning $30,000 a year, we'll use an old retiree. Number 2, earning $80,000 a year, we'll use a construction worker. And number 3, earning $200,000 a year, we'll use a doctor. These 3 occupations give us a good spread of incomes, and they give us 3 different tax brackets we can work with. This way, you'll be able to see exactly how the fully franked dividend impacts each of these 3 people in the different income tax thresholds. Of course, country to country, the tax systems are different. However, these tax rates are pretty accurate for Australia. So looking at our retiree who's earning $30,000 a year, because of the amount he earns, he pays 20% tax. This means he gets taxed $20 on his $100 dividend. Now, the company has already paid 30% tax because it is a fully franked dividend. When the taxation office looks at this, they see that the company has paid more tax than the individual will have to. In this case, the taxation office pays out $10 of the $30 taxation credit that they've been holding. This is to prevent double taxing. In the second example, the construction worker's taxed at 30%. Therefore, he pays $30 on his $100 dividend in tax. This happens to be the same amount as the company tax rate. Therefore, the taxation office holds the money and there is no further amount due. In essence, the construction worker pays no tax on his dividend because the company has already paid this amount to the taxation office, which they've been holding. In the last example, we've got a doctor who's earning $200,000 a year. He's taxed at 45%. Therefore, the amount of tax he needs to pay on his $100 dividend is $45. This is more than what the taxation office is holding. Therefore, he has to cough up even more money in tax. That amount is $15. That brings the grand total up to $45, which is 45% of the $100 dividend. So you can see from this example how it works for different people earning different incomes. But what happens if we change some of the parameters a little bit? Not all companies pay fully franked dividends. Some companies pay partially franked dividends. This is where they haven't paid tax on the full profit. In this second example, let's have a look at a partially franked dividend franked at 80%. As you can see, the retiree is still getting a benefit. However, now the construction worker has to pay a little bit of additional tax due to his dividend payment. And unfortunately for the doctor, he's got to cough up even more tax. Let's run this one more time for a unfranked dividend. This means again that the company has paid no tax on its profits. As we can see in this final example, everybody has to pay tax, including the retiree. Now, it is worth considering that unfranked dividends are usually higher than fully franked dividends because the company's not paying the tax. However, this isn't always the case, and that's why it's important to know about franking credits and the impact they can have on your profits after paying tax. Okay, with those simple examples out of the way, let's take a detailed look at a real life example. Okay, so looking at this spreadsheet I've put together, we can see the benefit of having franking credits in the dividend payment. Down the bottom of the sheet, you can see the $672 saving that this person receives, earning a $90,000 a year salary, compared to earning a dividend which is unfranked. The dividend I've used in this example is AGL's dividend, and that is 80% franked. So if you were to run this exercise with a 100% franked dividend, you'd see an even larger saving. I'll include a link in the description so you can download this spreadsheet and have a play around with it yourself. From this, we can see the obvious benefits of having franking credits available in a dividend payment. The tax savings can be significant. Let's take a look at why some companies don't pay a fully franked dividend and why some pay a partially franked dividend. So of course, not all companies make profits every year. If a company doesn't make a profit, in general, they don't have to pay any tax. Now, in this situation, you would expect no dividend. However, some companies such as Transurban, which I've spoken about in a previous video, do pay dividends even though they're making a loss. In this scenario, their dividend this year is fully unfranked. There's going to be no tax paid on their dividend because there's no tax to pay. Other companies like AGL pay a partially franked dividend. One reason a company may pay a partially franked dividend is because they're bringing forward losses from previous years and reducing their taxable income using that method. In this scenario, the amount of tax they have to pay and the amount of profits they're earning are not balanced. Therefore, they have to reduce the amount of franking credits on the dividend payment. So how can we tell what companies pay fully franked dividends and what companies don't? Well, luckily there's some really good resources out there online which make it super easy to check these things. I've linked one of my favorite websites down below in the description, so make sure to check that out. This website gives you a really good visual guide of past dividend payment history, and it also tells you the percentage of the dividend that has been franked. So after watching this, guys, I hope you can agree that it's important to check whether a dividend is franked or not before deciding to make a stock purchase because of its dividend payment. Now, of course, the higher your income, the more important it is to take dividends that have franking credits in order to offset some of your taxable income. Well, I hope you guys learned something from this video. I sure enjoyed making it. If you've got any questions, please leave a comment below. And if you like the video, give it a big thumbs up. Don't forget, if you want to check out my dividend growth portfolio, I put out portfolio updates every week, so be sure to check those out. Well, that's all from me for now. Thanks so much for watching, and I'll see you in the next episode. Cheers.